Welcome to Part A of a six-part English masterclass on the balance of payments and exchange rate regimes. In this opening video, we build the balance of payments, the system of accounts that every country uses to track all of its international financial flows. By the end of this video, you will understand what the balance of payments is, how it is structured into three sub-accounts, and why these three accounts must always sum to zero by accounting identity. We will also walk through concrete examples so the abstraction becomes tangible. Let us begin. Section 1. What is the balance of payments? The balance of payments is the comprehensive record of every economic transaction between residents of a country and the rest of the world during a given period, usually a quarter or a year. Every export, every import, every cross-border investment, every foreign loan, every remittance, all of it gets recorded in the balance of payments. The purpose is to give policymakers, investors, and academics a clear picture of how the country is engaging with the global economy. Is it earning more than it spends? Is it attracting foreign capital? Is it losing reserves? The balance of payments answers all these questions in one structured document. Section 2. Three sub-accounts. The balance of payments has three main components. The current account, abbreviated CA, records flows of goods, services, income, and unilateral transfers. The capital account, KA, records one-time transfers of capital, like debt forgiveness or migrant transfers. The financial account, FA, records purchases and sales of financial assets across borders. Each account captures a different kind of economic relationship. Together, they cover everything that crosses the border. We will look at each one in detail. Section 3. The accounting identity. Here is the foundational mathematical identity of international finance. CA plus K, A plus F, A equals 0. This is not a theory. It is an accounting identity. It must hold by construction. Every transaction is recorded twice, once on the receiving side, once on the offsetting side. The double-entry bookkeeping guarantees that the sum is always 0. If a country runs a current account deficit, buying more from abroad than it sells, that deficit must be matched by a capital or financial account surplus. If a country runs a current account surplus, the money flows out as foreign investment. The identity captures this iron logic. Section 4. The current account explained. The current account has four components. First, trade in goods. Exports minus imports of physical products. This is what people usually mean by trade balance. Second, trade in services. Tourism, financial services, software exports. Third, primary income. Income earned by domestic residents on foreign investments, minus income earned by foreigners on domestic investments. Fourth, secondary income, or unilateral transfers. Remittances from immigrants, foreign aid, gifts. Together, these four components give us the current account. A current account deficit means the country is net borrowing from the world. A current account surplus means the country is net lending. Section 5. The capital account. The capital account is the smallest of the three. It records one-time capital transfers and acquisitions or disposals of non-produced, non-financial assets. Debt forgiveness goes here. Government transfers for specific projects. The sale of patents or copyrights internationally. In most modern economies, the capital account is a tiny fraction of the total balance of payments. But for some specific countries, particularly those receiving significant foreign aid, it can be significant. Conceptually, the capital account fills the gap between the current account, which is about flows of income and goods, and the financial account, which is about flows of assets. Section 6. The financial account. The financial account is where the bulk of cross-border flows happens in modern globalized economies. It records purchases and sales of financial assets across borders. Foreign direct investment, when a company buys or builds a factory in another country. Portfolio investment, when investors buy foreign stocks or bonds. Other investment, bank loans, trade credit, deposits abroad. And reserve assets, the foreign currency holdings of the central bank. In a typical open economy, the financial account is many times larger than the current and capital accounts combined. It is the engine of modern international finance. Section 7. A worked example. Let us see the identity in action. Suppose a country has a current account deficit of 50 billion. It buys more from the world than it sells. Where does the money come from? Either foreigners invest 50 billion in the country, bonds, stocks, factories, which appears as a positive financial account, or the central bank sells 50 billion of foreign reserves, which also appears in the financial account, but with the opposite sign. Either way, the sum is zero. CA of minus 50 plus K, A of 0 plus F, A of plus 50 equals 0. The accounting closes. This is the iron discipline that the balance of payments imposes on every country. Section 8. Why this matters. Why should anyone care about the balance of payments? 3 reasons. First, it tells us if a country is financially sustainable. Persistent current account deficits, funded by short-term capital inflows, can suddenly stop, leading to crises like Argentina in 2001 or Greece in 2010. Second, it tells us about currency pressures. A widening current account deficit puts downward pressure on the currency. Third, it tells us about policy options. Countries running large surpluses have policy room to stimulate domestic demand. Countries running large deficits face constraints. Every macroeconomic analysis ultimately needs to consult the balance of payments to understand a country's external position. Conclusion: we have built the basic framework. The balance of payments tracks every cross-border transaction. It splits into 3 sub-accounts: current, capital, and financial. By accounting identity, the 3 sum to 0. The current account captures trade, services, and income. The financial account captures asset flows. The numerical example showed the identity in action. In Part B of this series, we work through detailed exercises that will solidify all of these concepts. If you found this introduction useful, please share the video with someone who would benefit. And subscribe to Macroeconomics with Michael for the rest of the series.